Okay, a lot has been happening for the domestic gas companies. Brokerages are now coming in with significant upgrades, particularly for IGL. And there seems to be a few regulatory changes that are kicking in, as well as a lot more opportunity that seems to be on the horizon for these companies. So open access in the CGD sector is the first thing. The second thing is unified tariff for gas pipeline networks. And together these culminatively result in structural volume growth and strong pricing power for companies like IGL. So what the open access impact is, it disallows OMC's existing outlets to compete with CGD companies. They aim to incentivize the creation of additional infrastructure while doing this, and they will reduce competitive threat from OMCs for IGL's key CNG businesses. Then on the unified tariff for gas pipeline networks, it's actually revenue neutral for gas companies. It's likely, however, to boost domestic gas consumption in the long term and improving competitiveness of gas for earlier untapped consumers. So why particularly IGL, and why are we flagging them off? IGL's strong pricing power, with CNG being 40 to 60% more cost competitive than petrol or diesel. Structural volume growth from the lucrative NCR market is another key trigger. Tapping into new lucrative nearby cities and intercity traffic is also a new growth avenue that the company is avidly exploring. Then Morgan Stanley Asia actually expects IGL's industrial volumes to increase at a 7% CAGR. Let me tell you, Kotak Equities as well as JM have strong buys on IGL, and they all have an ad rating on it with targets of above 520 rupees per share. Currently, there's also a huge opportunity on the industrial end of things because there are complexes which are currently operating on far less efficient and more polluting fuels. And now it seems that there's an industrial shift to PNG and gas as a preferred source of fuel for these industries. And that will actually give companies like IGL an opportunity and a tailwind to essentially gasify the entire fuel network for these various industries. So that is one of the largest opportunities available as well. In light of all this, we caught up with the management this morning on ET Now, and what they told us was they do not see any regulatory threat to the businesses. They do not foresee any price increase to consumers, which is obviously a key aspect. IGL is currently selling the cheapest CNG in the nation at rupees 42 per kg, so that's also another trigger. BS4 to BS6 has not only taken car costs higher, but it's also increased the fuel cost. So CNG being 50% cheaper than alternative fuels would be a preferred source in their view. April volumes were down 20% in the pandemic. They're now almost back to 96% of pre-COVID levels. And for next year, they're targeting around a 15% volume growth. That's said to us by the management. And again, he highlighted what a big opportunity the industrial shift to gas as a preferred fuel is. So keep your eye out on this one. Brokerage is fairly bullish on it and on the sector. So companies like MGL and GAIL will also benefit. But IGL clearly stands out as the preferred pick among brokers.